got the guy riding in on the black horse, because this is kind of like us going to the roulette wheel, and I'm betting on red, and I'm betting on black with the blackberries, and Ken apparently wants to bet on red, so we're going to win and lose, maybe.
Yeah, if you could pass the screen to me, Mark, please.
Okay, let's go ahead and do that.
I think Ken's going back to his educator days and looking for an apple.
Okay, I'm going to switch it to you now, Ken.
Thank you. And I'm going to start with the value line report. I've done a lot of work. Mark did the original work, or the original research, and then I've done a lot of reading as well on Nicholson's idea of a triple play. Nicholson was fascinated with this idea that if three things were happening with the stock at the same time, that you might have found something that's a real gem, and you should pay a lot of attention to that when you see it happening. And the three things were a depressed stock price as evidenced by a high potential return, the potential for the PE to expand, and the potential for the net margins to expand over the 3 to 5 year period that we normally talk about. And I did the same kind of deep value screen that Cy and Mark did. I did some other screening as well, and Apple kept popping up. On that deep value screen that Mark had, you'll notice that Apple had the highest financial strength rating of all of the companies that were on that list. And right above Apple was the other company that I had considered for this evening, and that was Logitech. I'm going to go with Apple because I decided to stay with a company in the United States. I'm having a difficult time with all these currency fluctuations up and down and left and right and everything, and Logitech's a Swiss company. And I just didn't want to have to try to get into figuring out what was going to happen to the company and then trying to figure out how the currency on top of that impacted what the company was going to deal with. I like to keep my investing as simple as I possibly can. Yes, I know Apple's had some issues with a fire at a factory in China that is manufacturing some of their most popular products. I really do think they'll have that underhand, and it's not going to be anything other than a blip on the horizon going forward. But let me point out this triple play that I see going on in Apple by just looking at the straight old value line sheet that I get from my library. I actually subscribe to it, but you can get it from your library. Most of you can. I start by looking at the projections over here in this box, the high and the low projection, and when I'm looking at a company that sells as much as Apple does, and Value Line is telling me that I can still stand to make 19 to 29% sometime in the next 3 to 5 years, I'm pretty excited about that, and I think that kind of tells me that there might be a depressed stock price. I notice that on top of everything else, these returns are based on a price of $351. And Apple has been trading closer to $335, $338, somewhere in that range for the last couple of days. So with a lower price here, these returns won't be anything except maybe even a little bit higher. The second thing I look at is PE ratios. Here's the current PE ratio based on that price of $350. The PE ratio is actually pretty close to this number, even at that lower stock price. I'm looking down in the body right here, and I see this line that says average annual PE ratio. And I noticed that in 2010, the average PE was 15, and yet we're projecting 3 to 5 years into the future a PE of 21. That says PE expansion as far as I'm concerned. So depressed stock price as evidenced by the return projections, the potential to expand the PE as evidenced by the numbers themselves, and then I look down at this net profit margin line down here in the array. I'm moving my cursor over the top. I notice the 2010 net profit of 21.5, 2011 estimated at 21, and yet 3 to 5 years in the future, an estimate of about 25% Well, that says expansion to me. It looks like, in my mind at least, that all three of Nicholson's triple play events are in place, and that makes Apple a very appealing stock as far as I'm concerned. I love to look at some other sources, and here I am looking at the Morningstar report, and I'm just going to read out that first line in the Morningstar report. It actually is a very well-written, very comprehensive report. If you're going to consider purchasing the stock, I urge you to read it. But this first line I just love. They're sticking with an estimate of $475 fair value for Apple after reviewing the company's second quarter results. Well, trading it at $335 with a fair value of $475 says to me that Apple might very well be something that I want to take a look at. So I do a very traditional stock selection guide. I love the zero debt. I always like companies with no debt, and the bigger they are, for the debt to still stay around zero, I think is fantastic. If I classify the company by size according to actual amount of sales, this is a very large company. If I classify it the way Nicholson did, by sales growth, then this becomes a pretty nimble company. It becomes a small company. We can talk about that at length at some other time, but I look at the most recent data. I've put the projections for the next couple of years on the graph. I will state that there's an optical illusion going on here. Remember that to be absolutely correct, this dotted line needs to be picked up and placed at this dot right here, and that would move this dot to the middle of these two lines and this dot to the middle of these two lines. So these don't actually line up as neatly as they appear. In fact, they're a little bit conservative when you put them actually where they belong on the projection. I'm very, very happy with being on the conservative side. And my judgments show, if I can move this down a little bit right here, my judgments show 15% at the sales and about, I can't read it myself there, it's about 14%, I think, at the earnings.
14 on the earnings scan, yeah.
Thank you, Mark. I'm going to turn this over. I love 2A and 2B. Net margins, pre-tax profit margins on sales seem to be moving up. You know the drill that you're looking for these numbers to be moving in an upward progression. Flat is okay, but up is better, and these are certainly moving up, as is return on equity. I love the up even. I can't get much better than that. I'm looking at PE values if I'm going to do traditional zoning, and I've decided on 24 and 14 as reasonable numbers. There's certainly room for discussion, but I think they're reasonable. I've chosen 2098 going forward for the trailing 12 months. I get a stock price of around $300 at the low price. I mentioned it's at $335, $337 right now. That's a fairly high upside downside for an SSG that I do. And yet I tend to believe that there's a lot of bad news kind of boiled into Apple right now. This fire at the factory, Steve Jobs' health. There's some underlying currents of badness surrounding the company, and so I'm going to believe that is it's okay. I might go back and adjust these numbers just a little bit, but I'm getting returns that are very, very close to value line returns when I take a look at that. And when I'm all said and done, I compare this to manifest investing, and lo and behold, my return is within a point of manifest investing's return too. I just can't find very much not to like about Apple for all the same reasons that Mark likes RIM. I like Apple. I like the fact that it's hardly penetrated the personal computer market, and yet more and more as I work with Better Investing members or other investors throughout the country, I find that Mac is becoming more and more prevalent. Mac's still only 5% of the computer market. The iPhone, the iPad are becoming ubiquitous. That's a nice word. I love it. And I think that it's a great stock to add to our portfolio. So my choice is Apple.
Cool, Ken. Thanks very much. Dan Hess actually made a comment that can actually be directed at both of us. He says that in his communications, he's aware of many companies that are switching away from the BlackBerry for their corporate networks and switching to iPhones. If you want to comment to that.
I know anecdotally that that's true. I know my sister's boyfriend who works at BASF. He's in a highly trustworthy position, works with a lot of people underneath him, and the whole division has moved from Blackberries to Android phones. Rob Stevens says he just bought his first Mac computer. Nancy Bethay says, do I think Apple might split? And, I would guess that it wouldn't. I think that it really likes the cachet of being a really high dollar price stock, but I don't think that splitting makes that much of a difference one way or another, except maybe psychologically for a very few days. Charles Bard wants to know what % of Apple's sales is computers. Charles, I don't have that number at my fingertips, but I do know that the number is easily located in the most current annual report. In fact, there's a couple of really good graphs that break down the total company sales by product. Chris Hodgkin wants to know, do you think one should wait for Jobs to resign or die and then take advantage of the likely price drop? I don't know if I want to be that sanguine, Chris, but I do believe that if it's a good stock and if it's selling at a reasonable price where I can make a reasonable return, that I'm going to buy it now. Would I add to the position if there were a large drop in price due to a one-time event? I might, depending on how much money I had and what percentage of the portfolio Apple was occupying at that moment, and a lot of other factors. But I usually tend to buy a stock when my SSG says buy, and when I can confirm that my numbers are well within the ballpark of a lot of other analysts that I respect. I really like my SSGs to stay within the same general ballpark as Manifest does because I believe the Manifest numbers. It's a great double check for me. I love it when I'm within what Value Line is telling me is going to happen. I love it when Value Line and Morningstar are relatively together with their analysis. That tells me that either everybody's right or everybody's wrong, and of course, my psychology is everybody must be right. So I'm pretty comfortable purchasing the stock right now and not waiting any further.
One comment I might make, Ken, and there is a lot of talk and speculation about the Steve Jobs premium, and I guess the best personal example I can compare it to is as a member of the Mutual Investment Club of Detroit, we had an extremely large position in General Electric. And we used to always debate the Jack Welch premium. And just to give it some context, back in the early part of the last decade, there were times when GE was selling at a PE of 40, and I think the PE for Apple was in the teens. It's nowhere near that same type of elevated premium. And we see the same thing at Berkshire Hathaway with Warren Buffett. That's a built-in legacy premium that doesn't really seem to be there. And there are also some very good technology analysts that have looked the situation over, and they've come away believing that Apple is not as vulnerable to the innovation wall, or whatever you want to call it, as they may have been 10 to 15 years ago, the last time they went around and Steve left the company for a while. So there's been a pretty good transition of innovation and delivery characteristics at the company, and it's probably not the same situation. It'll certainly take a hit.
I certainly do remember that Jack Welch premium that was boiled into GE there, and wish, in fact, that I would have followed my own advice when that PE was up in the high 30s and low 40s as Welch approached retirement. But with a PE of 16, I think that while it'll take a hit, I don't think it's going to be the kind of hit that GE took when the PE dropped from 40 into the high teens. So I'm comfortable with this SSG. I'm comfortable with this triple play idea, and I do own Apple already. And in fact, in the last couple of days, have added to my position in an IRA account because I feel that it's at a very good price point right now.
Okay, well, thanks a lot, Ken. I am showing this at 9:45, so I think I'm going to bring down the gavel and bring the official part of the meeting to an end. But let's go ahead. Thanks everybody for attending, and thanks Ken and Cy for your work here. And we'll put together another one a month from now. But we will stick around for any questions that people want to questions or comments for the next 15 minutes or so.